Even though they've started to rise recently, mortgage rates do still remain near historic lows, although experts do predict they will continue to rise throughout the year. But depending on a few factors, you might not be able to get a mortgage at all. Let's take a look at just why most mortgage loans are denied. Hi, I'm George Poporad with eXp Realty, and today we're going to look at the #1 reason why most mortgage loans are denied. So, according to a NerdWallet report that looked at mortgage application data, 8% of mortgage applications are denied. The #1 reason for these denials is not a low credit score. An unfavorable debt-to-income ratio was responsible for 32% of mortgage denials. The debt-to-income ratio is historically the top reason for denials. The #2 reason, a low credit score, was responsible for 28% of mortgage denials. So what is the debt-to-income ratio and why does it matter? The debt-to-income ratio is simply your monthly debt payments, which can include mortgage payments, credit card payments, auto loans, student loans, personal loans, child support payments, things like that, divided by your gross monthly income. Most lenders want you to have a debt-to-income ratio that is ideally at or below 36%. Although this does depend on the specific lender, what type of loan you're trying to obtain, and some other factors. So say that your monthly debt is $2,150 and your gross monthly income is $6,000. Your debt-to-income ratio equals about 36%. So why does the debt-to-income ratio matter so much? The DTI is a solid indicator of risk. If you have too much debt or not enough income, a lender will see you as a risk, because how are you going to add a mortgage payment and additional homeownership expenses on top of an already stretched budget? So what can you do if you are denied a mortgage because of your debt-to-income ratio? If your debt-to-income ratio is above 36%, don't worry, because there are things you can do to get that down. Obviously, reducing your monthly debts or increasing your monthly income are two ways you can reduce your debt-to-income ratio. So look at paying down high interest rate credit cards first, and then move on to student loans and car loans. The benefits of paying down debt goes beyond just lowering your debt-to-income ratio, as it can also raise your credit score and free up discretionary income. When you have too much debt and not enough breathing room in your budget, you can also try to focus on boosting your savings. That way you will have a buffer from incurring additional debt in the future when unplanned expenses arise. The bottom line is this: lenders are not denying mortgages with high debt-to-income ratios just to be difficult. Lowering your DTI will truly make your finances and your life more manageable in the long term. And while it isn't the #1 reason why most mortgages are denied, a low credit score can impact your ability to get a mortgage. So review your credit report regularly to ensure that there are no errors and you know what's happening with your score. Lenders want to see a history of on-time payments and positively resolved accounts. The higher the credit score, the more likely lenders will be to offer their most competitive rates. If your credit score is lacking, making payments on time and paying down revolving debt will increase your score. If you have taken anything away from this video, please hit that like button and subscribe to my channel. And if you're thinking about buying or selling a home in the Cleveland area, or you just have some real estate or home related questions, reach out, let's have a conversation. Thanks for watching.